Hey everyone, it's Nate here, your friendly finance guy who makes money talk a little less scary. Last time, we talked about how payments work within one country. You know, that magical send button on your banking app that somehow moves your money in seconds. But here's the thing, that button hides a lot of complexity underneath. And when money has to cross borders, oh boy, things get messy. So today, we're going global. Let's uncover what actually happens behind the scenes. When you make an international payment, Section 1. Why international payments are so complicated. Domestic payments aren't exactly simple, but at least they happen under one system. One set of rules, one currency, one central bank. International payments, on the other hand, have to deal with, well, everything else. Different banking systems, time zones, regulations, message formats, even accounting rules. There's no single global authority that connects all banks together. So back in 1977, the banking world decided to fix that by creating SWIFT, a global messaging network. SWIFT basically allows banks around the world to communicate using a common format. It's like the email system for banks. They don't move the money themselves, but they make sure every message says exactly who's paying whom and how much. Section 2. The trust problem. Counterparty risk. Now, even with SWIFT, there's a big issue left: trust. When Bank A in Korea sends money to Bank B in the US, how can they be sure the other side will actually pay up? That uncertainty is called counterparty risk. The risk that your trading partner might fail to deliver the money on time or at all. In domestic systems, this isn't a problem because the central bank acts as a trusted hub. But internationally, there's no global central bank. So how do banks trust each other? They use a few clever methods, mainly three. 1. Pre-funding through Nostro and Vostro accounts. 2. Using intermediary correspondent banks. 3. Real-time settlement systems. We'll focus on the first two today, the traditional ones. Section 3, Method 1, Pre-funding. Nostro Vostro accounts. Pre-funding basically means depositing money in advance. Here's how it works. If a Korean bank wants to make frequent payments in US dollars, it opens an account inside a US bank and keeps some money there. That account is called a Nostro account, our money held with you. And for the US bank, that same account is a Vostro account, your money held with us. When the Korean bank needs to send dollars to an American company, it just pays directly out of that pre-funded account. That way, there's no waiting and no trust issue, the money's already there. Sounds nice, right? Well, not so fast. Pre-funding locks up a lot of money across different countries and currencies. The more partnerships a bank has, the more cash it has to park overseas, just sitting there, not earning interest or being lent out. And if you're a small or developing country bank, you simply can't afford to pre-fund accounts everywhere. That's why this system only really works for large global banks. Section 4, Method 2. Using intermediary correspondent banks. For smaller banks that don't have Nostro accounts everywhere, there's another solution. Intermediary banks, also called correspondent banks, think of them as middlemen who already have a big network of connections. When your local bank can't reach a foreign bank directly, they send the payment through one or more intermediaries. The downside, the more middlemen involved, the slower and more expensive it gets. Kind of like too many stops on a flight itinerary. Each intermediary takes a cut, converts currencies, checks for compliance, KYC, AML, and adds processing time. Section 5, Example. A Korean bank sends money to the US. Let's say Bank A in Korea wants to send money to Bank B in the US. Bank A doesn't have a Nostro account in the US, so it finds another Korean bank, intermediary Bank 1, that does. That bank, in turn, might not be directly linked to Bank B either, so it uses a US partner, intermediary Bank 2. Now, we've got two intermediaries in the chain. The payment journey goes like this. Bank A sends a swift MT103 message, the payment instruction, to Intermediary 1. Intermediary 1 checks compliance, KYC, AML, sanctions, converts the currency from KRW to USD, applies fees, and sends an MT202 message to Intermediary 2. Intermediary 2 does the same checks, deducts its own fee, and finally transfers the funds to Bank B. The actual settlement, the final movement of money, only happens once, at the very end. When the last intermediary sends funds to Bank B, everything before that is basically ledger adjustments between banks. Section 6. The inefficiency problem. Here's where things get painful. Banks around the world don't operate 247. They process payments in batches at specific times, not instantly. So if your SWIFT message arrives outside business hours or before a weekend, the transaction just waits. This delay traps money in limbo. We call it trapped liquidity. And during that time, exchange rates can move, creating FX risk. So banks have to hold even more extra liquidity, just in case, which increases costs even further. And remember, this was just one route between two developed countries. If the payment involved smaller economies or less common currencies, you might have 3, 4, or even 5 intermediaries, and a transaction that takes days or weeks. Section 7. A look at the future real-time settlement. Clearly, the old system has issues. It's slow, expensive, and ties up liquidity. That's why a new wave of innovation is emerging: real-time settlement systems. Instead of waiting hours or days, these systems settle payments instantly within seconds. How? Through technologies like distributed ledgers, smart contracts, and digital bridge assets. One well-known example is Ripple's on-demand liquidity ODL, which uses digital assets like XRP to bridge currencies in real time. The idea is simple but powerful: remove pre-funding, eliminate counterparty risk, and make money move as fast as information. So there you have it, the hidden machinery behind international payments. From pre-funded Nostro accounts to long chains of correspondent banks, it's a system that works, but not without friction. Next time, we'll dive into how blockchain and digital assets are transforming this space, and whether they can finally make cross-border payments as fast as sending a text. Thanks for watching, and as always, stay curious, stay informed, and I'll see you in the next one.